Welcome to this explainer. Listen, if you're a freelancer, a small business owner, or a startup founder operating in Europe, you've probably heard the rumors, right? European taxes have a notoriously intimidating reputation. These seem incredibly complex, heavy, and just full of bureaucratic red tape. But what if I told you that with the right structured approach, the European Union is actually packed with incredible incentives and perfectly legal avenues to keep your hard-earned money? Today, we're going to walk through a highly practical, step-by-step action plan to legally reduce your costs and optimize your business for some serious growth. Okay, let's dive into this with a fundamental truth. This formula, which comes from financial principles at Private Bank, establishes exactly why proactive tax optimization is literally your ultimate tool for actual profit. It's so easy to look at your top-line revenue and feel great about it, but your real return, the money you actually get to put in your pocket or reinvest into your business, that is what's left over after taxes, bank fees, and the silent thief of inflation take their cut. Now, you can't really control inflation, but you absolutely can control your tax liabilities and fees with a smart setup. Optimization isn't just about paying less. It is absolutely crucial for maximizing your real, actual return.
So to get you there, here is the definitive checklist we will cover today to transform you from a confused expat into a highly tax-efficient European business owner. The European tax landscape, choosing a jurisdiction, optimizing your structure, smart VAT management, maximizing deductions, and finally, automation and support. Let's get right to it.
Step 1. The European tax landscape. Understanding the rules of the game.
Understanding your tax residency is the absolute foundation of all European tax planning. Seriously, you cannot optimize a single thing until you know exactly where you legally owe taxes. There's a massive trap here for digital nomads and expats. A lot of folks assume that just because their business is registered back in their home country, they only pay taxes there. For example, simply keeping a Ukrainian FOP or any home country sole proprietorship does not magically exempt you from EU taxes. If you live in an EU country for 183 days or more in a year, or if your center of life interests, like your family, your permanent home, or your main economic ties, shifts to that new country, well, you become a tax resident there. The second that happens, you are subject to their local tax laws on your global income. It's a total game changer, making it vital to understand local rules before you make a move.
Moving right along to step 2, choosing a profitable jurisdiction, or what we'll call the geographic tax door.
The sheer beauty of the European Union is that while it acts as a single market, the individual member states have vastly different tax codes. And this brilliantly illustrates how picking the right jurisdiction directly slashes your baseline costs. If you're an IT professional, there's absolutely no reason you have to suffer under a 40 or 50% progressive tax rate. Think about Czechia. If you use their expense lump sum deduction for freelancers earning under a €75,000 limit, your effective tax rate plummets to an incredible 6 to 7%. Or look at Poland, offering a 12% flat lump sum rate for specific IT activity codes. Even Portugal, with its non-habitual resident program, offers a flat 20% rate with exemptions that can drop it down to just 7.5% in your first year. Choosing the right spot on the map is, hands down, your biggest optimization lever.
That brings us to step 3, optimizing your business structure and setting up for success.
Location is only half the battle, folks. The actual legal entity you choose dictates not just how much you pay, but exactly when you pay, and how well your personal assets are protected. The contrast here is stark. As a solo freelancer, like an FIE or FOP, you face personal liability for business debts, and you're taxed immediately on whatever profit you make at the end of the year. But consider a limited company. Establishing an Estonian OU, which is a private limited company, gives you limited liability. But here is the real kicker. Estonia has a 0% corporate tax rate on reinvested profit. 0. You only pay corporate tax when you actually take money out as personal dividends. Plus, having a formal EU company structure gives you way higher trust with European client and digital banks.
Now, you might be thinking this sounds incredibly complicated to set up, but it's actually easier than you'd think. Estonia's digital infrastructure lets you do the whole shebang completely remotely. Here are the clear steps. Step 1, get your e-residency. This acts as your digital key to the EU market, letting you sign documents online. Step 2, register your OU company format online. Takes just a few days. Step 3, open a multi-currency business account with a fintech provider like Wise or Revolut. They integrate beautifully with Estonian companies. Step 4, register in the EMTA, which is the Estonian tax portal. It is a clean, hyper-efficient, and optimized corporate structure that you can manage from your laptop literally anywhere in the world.
Next up, step 4, smart VAT management.
So the crucial point here is that often completely terrifies new business owners. It just seems like extra math and a bunch of extra costs. But actually, registering for it can be a massive benefit for you. It's a highly logical system, and when you manage it smartly, it absolutely reduces your overall tax bill. For instance, if you have an Estonian company, but you're providing B2B IT services to clients in Germany, or the US, or the UK, those exports generally qualify for a 0% VAT rate. That means you don't have to charge your international clients extra, keeping your pricing highly competitive. On top of that, having a registered VAT number makes you look incredibly professional and established to bigger corporate clients.
Furthermore, being VAT registered lets you claim back the VAT on your own business expenses. Let's break down this concrete example based on principles outlined by Ocean Bank. Say you go out and buy 6,000 units of currency worth of office furniture or tech gear, and baked into that price is 1,000 units of VAT. Because you are a VAT-registered business, that 1,000 isn't just lost money, it generates a VAT credit. You can literally take that 1,000 credit and use it to offset any VAT you might owe the government from your own sales. It effectively makes your business purchases significantly cheaper. Let's move to step 5 and see how this builds into everyday operational tactics: maximizing deductions.
The golden rule of business taxes is this: you are taxed on your profit, not your revenue. So legal deductions are your absolute best friend. Depending on your specific EU jurisdiction, the rules will vary, but let's rattle off these highly practical deductions based on the German model. If you work from home, you can claim a home office Pauschale, which is a fixed daily compensation. Need a new tablet or monitor? Tech devices under €952 can often be instantly written off at 100% in the very first year, rather than slowly depreciating them over time. You can deduct professional training, software subscriptions, specialized literature. Germany even has a category for special expenses under €300 that require minimal proof, literally just a bank statement. Lowering your tax base is really just a matter of knowing the rules and keeping track of the right receipts. And our final point today, step 6, automation and support to stay compliant and audit ready. Okay, so you have a great jurisdiction, a rock-solid structure, and you're tracking VAT and deductions. But trying to manage all this in an Excel spreadsheet, that is a recipe for disaster. Manual tax math is completely a thing of the past for modern EU small businesses. Now, what's really interesting and a bit of a wake-up call is this €200 to €300 fine. That is the exact penalty you might face in Estonia simply for missing the deadline for your annual report. Missing VAT filings can trigger even more monthly fines and interest. This proves exactly why you should never, ever do this manually. By using automated tax and accounting software like Zolo for Estonian e-residents or TaxJar or QuickBooks, you eliminate human error. These systems automatically categorize your expenses, track your VAT thresholds, and ensure you never miss a filing deadline. It saves you from completely unnecessary fines and a whole lot of stress.
So, we've walked through the landscape, the jurisdictions, the structural hacks, the logic behind VAT, the deductions, and the sheer power of automation. By combining all of these elements, you aren't just surviving the EU tax system, you are leveraging it for maximum growth. The tools, the treaties, and the technologies are all right there waiting for you to use them. So, are you ready to stop fearing European taxes and start building your ultimate audit-proof growth engine? Thank you so much for joining me on this explainer, and here's to your optimized success.